And now, we welcome the speakers to the stage for our first panel, When Uncertainty is Certain, Strategies for Banks. The panel will explore the challenges banks are facing to stay competitive and resilient. It will be moderated by Nick Comfort, finance reporter at Bloomberg. Nick has covered ECB Banking Supervision since its beginning in 2014, and he has proven to be one of the ECB's most inquisitive followers. Nick will introduce the panel members and welcome audience questions later in the session.
All right, well, welcome also from my side. Thank you to the ECB for having me too. An audience of bankers and people who work with bankers or supervise bankers probably knows my panel already. They're well respected in their individual fields, and you know what? There may even be a little sprinkling of begrudging admiration or even fear in the audience today. But I won't say who it applies to. So we have Sharon Donnery, a long-serving member of the ECB Supervisory Board, with one of the most interesting portfolios for reporters like me, not just because she has communications in it. And we have Britta Schmidt on the end, a senior analyst at Autonomous Research, who I've heard grill many executives on quarterly earnings conference calls. Some of them were in the room. And last but not least, Andrea Orcel, the CEO of UniCredit, which is not only making the biggest shareholder payouts in Europe, but also buying stakes in other banks. So since she's our host, I'd like to start with Sharon. And I think that Claudia led us in, really put the focus on geopolitics. Let's start there, please. Now, the people in the room have probably heard many speeches from the Supervisory Board on this very topic, if they follow you as religiously as I do. Your colleagues have been warning about, and yourself, about geopolitical risk for more than 2 years now. It's still in focus, and as we also heard from Claudia just now, we know that the ECB stress test next year is going to be a reverse stress test. Maybe you could tell us a little bit about what that says in terms of the evolution of your approach to it and what you're expecting from banks. Is the question of the banks having to get creative?
Okay, well, good morning, everybody. And just before I answer that question, let me just join our chair and vice chair and our whole team here at the ECB and welcome you all to our forum, whether you're here in the room with us or online. We're really delighted to see so many of you. So maybe just I emphasise one or two points that the chair made already in her opening remarks about geopolitical risk, and then we come to the reverse stress test. So of course it's not new. I mean, it's been in our supervisory priorities, I think, as you mentioned, for a couple of years now. And we will announce shortly our supervisory priorities for next year. But I think you can tell already, even from Claudia's remarks just now, that it will remain kind of high on our list and a special focus for next year too. As I said, it's also not a new risk in the sense of having to think about new requirements, and it's all about how it links with credit risk and market risk and operational risk and so on. But I suppose the way we think about how geopolitical risk feeds through into the banks is around these channels, which Claudia touched on as well. So through the real economy channel, through financial markets, and through safety and security. And that's obviously the strong link also to cyber. So very important, I think, to emphasise not a new risk and really a cross-cutting risk driver, like many of the things we see at the moment, like climate and digitisation as well. So on stress testing, and I'll come to the reverse stress test in a moment, but just to emphasise, I suppose, for us, the importance of stress testing as a supervisory tool. And you would have seen on Claudia's later slides about our reform and the simplification agenda that stress testing is also part of that in terms of course, making it simpler and maybe less data and resource demanding. But it remains a very, very important part of our toolkit. And we had the stress test this year, obviously, which already included geopolitical risk. It was very much focused on supply chain disruptions, trade tensions, and confidence effects, which I think in the end actually turned out to be really quite relevant in terms of how things have evolved this year. Now, while the stress test this year was, of course, really, really important, it is a single adverse scenario, and maybe something that it doesn't capture so well is the very specific vulnerabilities that can apply in different banks, depending on their own circumstances, their own business models, for example. And I suppose it's with this differentiation or this type of idea that we have come to the idea of a reverse stress test and why we think it's very timely at the moment and makes sense right now. I think a very important part of it is also the idea of linking this reverse stress test exercise with the bank's own ICAPs, or their own internal capital adequacy assessments. So instead of giving a scenario this time, what we will do, and I mean it's still being scoped, and I see some of the team here actually because we're in some dialogue with the banks at the moment about how exactly it will work. But the idea is that we give a predefined target outcome. So for example, we might give a targeted CET1 depletion, and this then becomes the starting point for the reverse stress test. Now, as well as looking at what happens when the banks do the reverse stress test to look at this sort of target outcome, I think a really important part for us is also making sure that we look at how the banks design the process internally and how they select their scenarios, and then how this sort of fits with their ICAP. Because really a key objective for us in doing this type of stress test is to foster the bank's own risk management capabilities. So really testing not just how do they get to that number, but how does the bank actually work itself internally in terms of its own governance and risk management. And here I think the wider link to ICAP is really important. This has also been one of our priorities for quite some time, to sort of strengthen banks on their own ICAPs. So we think it will really support that. We will also, within the reverse stress test, look at some particular issues around funding and liquidity. So banks will be asked to look at some funding and liquidity metrics, which is quite important. And this will be both quantitative and qualitative. Then maybe the last thing I would say is it's very important to emphasize this is not pass-fail. So it's really not sort of set with that in mind. As I said, it's really about understanding banks' own governance and risk management, their broader ICAP. It will, of course, feed into our SREP assessment, so it could, of course, affect the banks in that way. We'll give the banks specific feedback on things that we expect need to be addressed, and we will also plan to have some kind of overarching communication in terms of our general findings after the reverse stress test is completed.
Okay, I'm looking for the liquidity side of it too. It sounds interesting. But Britta, maybe we could move to you to kind of zoom out a bit, to have the perspective from outside of this building. You speak to international investors in big banks. Are they as freaked out about geopolitical risk as one might have the impression from these various speeches? And also, is there also maybe a differentiation between different types of banks in terms of how investors view their geopolitical risks?
Yeah, firstly, thank you very much for having me. Maybe I wouldn't be an analyst if I didn't bring some slides. You've asked me to bring some charts, so I've brought some charts. So maybe if we can take a brief look at the second slide, please. One further. If we look at just setting the scenes as to how banks are doing right now in investors' eyes, I mean, for the last 15 years, banks have underperformed the general market with a variety of risks that have emerged. And since the onset of rate rises, profitability has greatly improved, and we see that reflected in the share prices of the banks. If you look at the chart on the right-hand side, you can see that the share price performance and total shareholder return has far exceeded the rest of the general sectors, and earnings revisions have, by and large, still been positive. Even the last quarterly results season, most management teams have been quite constructive, especially on things like cost of risk, for example. If you compare that to the rest of the European sectors, how they've traded and where earnings revisions have gone, of course, it would make you quite negative. And you would think, there must be some risky areas that are ahead. But to your point, Nicholas, we do find that investors understand very much how the banks are diversified geographically. Not every bank is exposed to every trade corridor that might be at risk. We also see diversification in business models, mortgage lending, consumer lending, corporate lending. Not all of that will be impacted in the same way. If I think about what have investors asked us about the most, where they're seeing the risk, as you can see from the chart on the top right, auto exposure has been one of the areas that has been a particular focus. US consumer has also been more focused than European consumer. I think that's also a reflection of kind of the consumer lending market in Europe being not quite as deep as in the US, but there certainly the effects are felt. These exposures are also quite controllable, I would say. And the other area, one of the reflections as to why banks are in a good place right now, we've got high capital ratios, good profitability right now, which I think are the preconditions for being able to manage a challenging risk environment. But one of the things we also need to recognize is that a lot of these risks have shifted. They haven't disappeared, but they've shifted elsewhere. And this is where the discussion about non-bank financial institutions exposures usually comes up, which is, I think, a more difficult territory for investors to grab hold of.
Okay. And Andrea, I mean, so I'm sure we'll spend a whole lot of time today at this conference and tomorrow speaking about the resilience of banks, but maybe you could speak a little bit to the resilience of the wider environment and what can be done by supervisors, by regulators, by politicians to make sure that the environment is also supportive in weathering geopolitical turmoil for European banks.
Well, I think, if we take it from that angle, I think we're stronger if our economic bloc is stronger, if you want to start from broader. So the more Europe is fragmented, the less you're strong as a bank. The more my capital is boxed in 13 countries and I cannot freely move it from one country to another. The more my liquidity is boxed in 13 countries and I cannot freely move it from one country to another. The more we cannot leverage the scale to become stronger, to diversify, because I need to have IT servers in every country where I am, technology in every place where I am. That's cyber risk, because I have multiple points of entry. So I think, but we all agree here, if Europe was growing in a stronger economy, if we had banking union, if we have strong capital market union, if a lot of risks that are currently on bank balance sheets were to be more broadly spread, the general strengths would increase. Now, that does not mean we're not strong at the moment, but does mean that we need to look at things in a very, very different way. So if you take us, for example, we are very European. So we have taken a view that there is still a liability we carry, but everything else, we don't want to hear it. So last year we used to hold about 7 billion of US Treasury. Today we hold 3. That's the total for the bank, Treasury. We used to have treasuries from various countries in Asia. Today we hold 0. We don't take directional bets. We don't take interest rates bets. It's all reverted to floating rates. So as we manage things that way, a lot of people ask me, well, how did you prepare for Liberation Day? First of all, nobody did, to be fair. But I think it is a lot more what if. I think you need to have a trust. You have to create a framework and have a trust that you have a culture of quick reaction, and the people who take those quick reactions, you trust that they're going to take them within certain parameters. So we're in Germany, there was it Field Marshal von Moltke who said, your battle plans go out of the window within 30 seconds of meeting the enemy, and that is correct. So if we come from an environment of 15 years where low rate and liquidity was buffering all the volatility, globalization, cooperation, respect for your peers, et cetera, et cetera, et cetera. And now we go fracture, not respect your peers, enter into war, et cetera, et cetera. I think the way we manage that, and this is a big topic in our bank, is no longer backward-looking, big plan, budget, and let's see how you organize it. It is, yes, you need a direction, but the organization needs to be ready to shift almost weekly. Mm-hmm. And it's a completely different mindset. So we need to trust that people know where we are going, what is the framework they need to act in, but can react and adjust and react and adjust. I'll give you one example. We announced our famous UniCredit Unlocked in December 2021. Stock price went up, everybody was happy. Within a month, we binned it because Russia invaded Ukraine. And the entire environment, rates, cost of risk, geopolitical risk, volatility was shifted. But we had worked so hard on understanding where we wanted to go that every component of the group quickly reassessed and adjust to what they were doing to the new reality. So I do think that that is very, very important. So if the macro around you is better, it helps. But for us, it's how do we understand what happened? How do we know that I can do all the scenarios I want? I'm 100% sure. But what will hit me is something I didn't think about. Mm-hmm. And therefore, what does the organization do when you're hit? How fast? How consistent? What is the oversight? How do you intervene? That, for us, is a little bit of a way to go to get people ready.
Okay. And Britta, I'd like to come to you again, sort of picking up on, so I'm an optimist, but I'm not sure I am optimistic enough to think that Andrea will get capital and liquidity waivers for all of his 13 markets in the next 2 years.
No.
Again, some of the people in this room get to decide that. But one thing I am more optimistic on is CMU. I think that's something that we could have moved. Maybe you could speak to us, Britta, about the potential for banks from CMU, and also maybe also the strategic considerations that some banks may have with regards to their investment banking capabilities as a result of this actually, hopefully, one day moving forward soon.
I mean, first of all, political responses to the situation that we now have also provide opportunities, potential opportunities for banks. It is just what we're hearing right now from a lot of management teams, and I don't know whether Andrea will agree with that or not, is that it is less clear what exactly will emerge and how long it takes for political consensus to be able to drive these sort of projects forward. One of them is the Capital Markets Union, the other one is the Savings and Investment Union, but clearly Europe needs funding, and that funding needs to come from somewhere. With regards to the Capital Markets Union, I guess we again come to the topic of non-bank financial institution involvement here as well, which has got to be a little bit of more of a symbiosis, I guess, between banks and these institutions. But for banks, I think there are also opportunities in capital markets business. And I think from an analyst perspective, whenever we speak to investors about capital markets business, there's a little bit of an allergic reaction. And that is because they're typically seen as investment banking businesses that are very volatile, very risky, hard to predict, relatively high cost-income ratio businesses as well. But I think there is merit. We see more universal banks invest more in their capital markets business, not only in Europe, also globally. And I think there are opportunities to be exploited there.
Okay. And a term that's been used a couple of times today is ICAP. And if you're not a banking nerd like me, maybe some of the consumers audience watching this online, you may think it's a reference to a new product from Apple, a nice headwear. It's not. It's the internal capital adequacy, I'm forgetting an A. Assessment, thank you. But so this is something that Sharon has been addressing a couple of times here. And for the attention that has been placed on it, as critical outsider, might think that that ICAP plans at banks really aren't up to scratch, and that these may be standing in the way also of banks' plans to distribute capital. How should we read the tea leaves from you and from Claudia on this topic, Sharon?
Well, first, I suppose, to emphasise the real importance of ICAP internally within the banks themselves. And of course, for us then, as part of our supervision, to look at the bank's own governance, risk management, how they use their own ICAP, and what that means for us in terms of our supervisory assessment. And I mentioned the SREP, the Supervisory Review and Evaluation process earlier on, which is our sort of annual health check, let's call it, of the banks. So it's a pretty fundamental part, I suppose, of what we look at. And now in terms of distributions, I know you probably have something to say about that as well. I suppose for us it's about this very careful balance of banks understanding the risks that are there at the moment, but also other things that they have to do. So digitization has come up a couple of times, and clearly there's a big investment needed in terms of banks' approach to digitization and to their IT systems. I suppose the other thing that's also very important for us when we think about distributions is the individual circumstances of banks. So of course we can look at the banking sector in its entirety, but individual banks obviously vary in terms of their own positions, both in terms of their ICAP and the strength or weaknesses within their own ICAP processes, but also of course their own business models and their own need to invest in IT and so on. So I think what we've seen over the last year or two, and it was mentioned already, including in the charts, is the changed interest rate environment, this it's obviously had a very significant effect on banks' earnings and profitability. And we have seen an increase in distributions as a result. So I suppose for us, looking into the future, what we really want to see, I think, is this careful balance, understanding their own risks and exposures, whether that's to geopolitical risk, their need for strategic investments in IT and digitisation and so on, and seeing that then balanced against the need to pay distributions. Of course, I think if you go back to why we're here as supervisors, it's fundamentally to make sure that the banking system remains safe and sound. Why is that? Because it's fundamental to the economy. And we know that for banks to be able to operate, that many of them, of course, need shareholders and investors who need to get a return. So I think we absolutely accept that. It's about, I think, this careful understanding of this balance, but particularly, as I said, the importance of the long-term investment in digitisation. And Andrea mentioned, cyber resilience in particular, which, of course, requires careful attention and indeed investment.
I'd love to come to more on IT spending and distributions in a moment, but Andrea, I have to ask you a current issue as well. So you mentioned Russia early in your remarks. We had an announcement yesterday from the Kremlin and from Citigroup that they will be allowed to sell their Russian operations. Will we hear something new from UniCredit on this front as well anytime soon?
So, I think for us, Russia, firstly, we started the war. We had about 6% of our loans and local loans and deposits in Russia. We had $4.5 billion of cross-border lending to Russian corporates. If you fast forward to today, we have 0.2% of our loans in Russia, 0.2% of our deposit. I think we haven't given a new loan, obviously, since the moment of the invasion. We have about 700 million in lending, of which 400 to 500 is mortgages, which obviously I'm hostage to until they repay. The other 200 are probably going to come down and then stop there, and we're not renewing. Deposits stay, we're seen as a safe haven. In Russia, legally, we cannot not accept them, and that is an important point, but we have 900 million, we're happy about that. Contrary to public belief, or some people public belief, Russia finances the group, not vice versa, because we have 1.5 billion of deposits of Russian corporates in Milan and in Munich that we have been sitting on since the beginning of the war and are trying desperately not to give back. We've tried to get them frozen. We didn't succeed. While we have no lines back, of the 4.5 billion of cross-border, we recovered 100%. When the invasion started, we were quoted 30 cents on the dollar. We held. They were all repaid. So if I look at what we had when we started, we had about 2.4 billion of equity in Russia, and we had all of these things. Today, we have dividend out 600 million. Of those 2.4 billion, we have recovered the 4.5 billion of cross-border. But the capital there grew because of profitability. By way of what profitability? Because we're not lending and we are a safe haven, we take deposits from the market and we deposit them overnight at the central bank. And we're paid 15 points, which is a great business, as you can imagine. One that the Russians don't particularly appreciate that we do, but that's how we have grown our profitability. So now what is the issue with Russia for us? The issue for Russia is, one, navigating the sanctions. I remind everybody that after, 30 years, 40 years, Cuba has 250 sanctions. Russia has 15,000. So navigate that. And they're not coinciding. EU, Canada, UK, Australia, US, they're all different. They do not intersect. So managing that is a galactic effort of compliance to go through this and make sure you don't make mistakes. So that's a big challenge. The second challenge, at least for us, not to be nationalized. So the Russians have been very attentive at not nationalizing because they think that if they nationalize, they then owe you money after the war. So they want you to make a mistake to be justified to nationalize. So we try not to make those mistakes. Why? Because if we made that mistakes, we would legally hand it on a silver platter 3.8 billion of capital that I have in there. And there is no way I'm going to do that. Not for my shareholder, but also morally not as somebody from the West. I'm not going to do that because that money is going to go in one direction and one direction only. By the way, it's all cash because it's all excess capital. So then you have what is the worst that can happen. We say it every quarter, and Britta knows it because she follows our call. It's 80 basis points of capital. So going back on our distribution and our capital, we always have in mind that until this is resolved, 80 basis points can go overnight if we're nationalized. And therefore, they haven't. We've managed it well, but they can. Talking about, it's one of those 5% probability, 10, you can tell me 50, but I don't control it. It can happen. Obviously, if it happened, goodbye the deposits, because I'm going to try to keep my 1.5 billion on the other side, which offset more than half that amount. But this is how we're managing it day to day. We've obviously closed down retail, almost liquidated in full. So then you get to sale. What Citi has done is very different from us, meaning what they have sold is a custody business. So what is a custody business? The whole securities. Those securities are not distributing the dividend, the interest of their clients. They are sanctions. So it is a pot of gold. It is cash. And they have been allowed by Putin to sell that pot of gold to Renaissance, which is a Russian organization. Of course they have. The question is, but how much did they get? I have no idea. But for the Russian, is take direct control of all the unpaid interest, all the unpaid deposit, all the unpaid dividend, all the securities that are still there, but a lot of people still hold them there, American, Europeans, and also Russians outside of Russia. So I think this does not read across on other banks. Actually, if you look, with the exception of SocGen at the very beginning, everybody tried and failed. ING tried and failed, everybody tried and failed, because when you go to the last point, the rules for sales in Russia are no one can pay you more than 40% of book value, first. And secondly, on that 40% of book value, depending on what you do, you get taxed 35% or 75%. So for me, it's a gift to the Russian. And I'm not going to give a gift to the Russian at those conditions. Is there something that will move? I don't know. At the moment, there are 4 banks that almost account for 100% of the US dollar and euro payment on SWIFT. Those are ourselves, Raiffeisen, OTP, and ING. And those banks are semi-protected because the country wants those payment lines. Although, if you look at the total volume, they continue to fall as the Russian go through South Africa, India, Turkey, China. And so I think we're in a situation where we're almost saying something will happen. Let's be prepared for something will happen. It's actually quite mechanical. They nationalize me. Worst case scenario is 80 basis points. Best case scenario, it's 35. And I try to avoid it. It used to be 150 basis points when the war started. Now it's less. But I don't think there is much more than we can do than that. And obviously, the compliance part is very significant because we have two grids, one on country and one outside of a country to make sure that we catch what could be wrong. But I think if anybody asks me, are you certain? I can't be. There are too many sanctions. I can't be. Nobody can. Yeah. But we take it very seriously, and that's where we have it.
Thanks very much for that. To be honest, I mean, geopolitical risk as a concept
is
pretty hard to touch on. So I think you've given us, I mean, nothing is tangible as a basis point of capital, at least for banking nerds like me. Maybe if we could come back to you, Sharon. So you were mentioning, and to make a connection now to cyber risk. Obviously, it's obviously part of the geopolitical aspect and another very tangible area. So you mentioned about IT spending. Are you seeing enough IT spending at the banks?
So just to emphasise, I think what you said first, I think it was a really good example of the kind of practical reality of trying to manage it. Yeah. And it also goes back to what we talked about earlier about the whole purpose, I think, of the reverse stress test, which is exactly understanding all of these specific nuances in individual banks, which can vary quite a lot. So I think it was really useful to hear that. And now back to cyber. So first of all, on IT investment, there are two different dimensions, I suppose, and a bit like geopolitical risk is one of these kind of cross-cutting risk drivers. I think the whole area of digitization is also similar. It's fundamentally changing the economy and the financial system. So I think banks have to think about two different aspects of that. So one is IT investment in their own IT infrastructure for the purposes of how their banks function in this digital world and digital economy. And the competition, I suppose, that banks have also from fintechs and other providers. So that's one aspect. And then the other aspect is, of course, cyber, as you mentioned, which has this IT dimension, but also, and I think even more so in the last number of years, these aspects around geopolitical risk. And I think, to be honest, what we see is a lot of variability in different banks in terms of the size and scale of those investments, and also what banks really need to do. So I think on the cyber aspect, we see, of course, some good practices, but we would still see, I think, banks with quite a lot of challenges around things like managing disruption or managing incidents if and when they happen. So it's really important to be attentive to that. We also see some issues around, I suppose, what you could call, planned changes and how changes are deployed and rolled out, but then things happening with that and then having to roll back and so on. So the whole area, I think, of change management and planning. So I suppose what we expect to see is not just the financial investment that banks need to make in digitization and cyber, but also, I suppose, the investment that's needed in, time, planning, governance, and making sure that they are able to recover. And I think one thing, colleagues here who've heard me speak before will know I come from Ireland, and a number of years ago we had a very serious attack in Ireland on the Irish health system. It was highly disruptive, and one of the key learnings from that cyber attack was that assumptions around recovery times proved to have many weaknesses in them, and things that maybe people expected could be resolved didn't turn out to be the case. So I think this whole idea of really recovery times and planning around that is really, really important. And I think it goes back to the example Andrea gave us about really understanding your own business model, your own exposures, third-party reliance, and really going through all of that in a lot of detail, and then looking at different scenarios, which you said you're an optimist. I always say, I'm paid to be a pessimist. So in central banks and supervisors, we have to think about all the things that could go wrong. So looking at the scenarios that could happen, whether it's something you do yourself, like change management, something that happens in the wider financial system, or cyber vulnerability. It's about looking at all of those different scenarios and trying to make sure that you are resilient to them, because I think, as the examples show, we can't really predict what's going to happen. Yes. Who'd have predicted there would be a pandemic? Who'd have predicted, the horrendous situation with the war in Ukraine? Who'd have predicted where we are now, maybe on trade and tariffs? So I think we don't know what the scenarios are going to be. So Claudia talked earlier about this idea of broad-based resilience. And I think whether it's financial resilience or operational resilience, we have to think in those kind of broad ways.
Okay. And staying on IT, maybe moving to you, Britta. So you at Autonomous do an interesting survey annually, I think, on tech adoption and tech at banks. What are the data points that you're picking up on, both in terms of spending on the one hand, but are there other indicators that maybe get to the governance aspect that Sharon was mentioning?
Yeah, we now find that a lot of the annual reports and public disclosures of banks have a lot of words around digitalization and cyber risk, but there are very few numbers. Mm-hmm. So on that basis, we do our survey ourselves of around 50 mainly European banks. And I have brought with me a couple of results of that survey to show you. So maybe we can move to slide 3. That's it. So on the basis of our estimates and what the banks are disclosing, we do think that even excluding personnel and staff costs, they are spending around 20% of their cost base on IT, and that can be a number of different things. Of course, what we don't know precisely is what they're spending it on. And I think there's a big difference, as Sharon said. Some banks might spend it more on prevention of cyber attacks. Some might spend it more on resilience, building the resilience and the recovery. And I also find it interesting, I think there are some studies that suggest that even detecting a cyber incident can take more than 200 days and recovering from it takes more than 100 days. So there's certainly something that needs to be done. You asked about other measures as to how we look at how banks manage digitalization and also cybersecurity. And we see that the IT experience on the board has by and large increased. If you're thinking about 20% plus of the cost base being spent, then maybe having 10 or 15% of the board in IT still has room to grow a little bit further. I don't know whether it's worthwhile also touching on a couple of other points that we might touch on with regards to cyber risk. If we move to the next slide to see what are the biggest changes that we've seen, I think obviously a very big change has been cloud adoption. And we can see that even over the last 3 years, the banks in our survey, now around 70% of the banks in our survey use the cloud as their main infrastructure. And that is very important because this is going to be the host of most of the data. And I think this is also actually a really strategic point. Data, I think, is highly strategic to banks in a world where their business model is disrupted by fintech and payments. And by building a bank around data, I think, becomes ever more important. We found that almost half of the respondents in our survey have more than 50% of their data stored on the cloud. And this makes my next point really important as well, which is around identity and access management, which I think is a huge focus that also came out of our survey. And if we move to the next slide, interestingly, we asked the banks usually to rate themselves about the capabilities. How do they see their capabilities in certain areas? And identity and access management is one of these areas where the banks have actually reported a little bit less self-confidence, I would say. And I would argue that that's not necessarily a bad thing, because I think it might also be a self-reflection to see that more work needs to be done. Now here talking about, I don't know about you, but whenever I come into work, there's around 10 minutes I need to spend on having my face scanned, having my fingerprint taken, 2 different authenticator apps to be used to log into various different tools, which can be annoying, but it's actually also really necessary. I mean, we've seen some SME businesses basically be deprived of their entire business because of a deepfake CEO video being shown to the CFO, and on that basis clicking a button and transferring the entire cash stash of the company. What is very clear, though, is that cyber costs are going to increase. And the chart on the right there shows you that the cyber element of the IT cost base is going to increase, and it's going to increase a lot faster. This chart shows you that the cyber cost might increase from around 3% and doubling to around 6% in a couple of years. I think what I see within some of the banks is actually that the cyber risk cost as part of the cost base is already higher than what we see on the chart there. So it's undeniable that banks are spending on this. Banks need to spend more on that. And I find it particularly interesting that the size will also make a difference, I believe. We've heard more M&A investment cases also being framed around the potential for investment into digital and IT.
Okay. And then, so we've heard a lot, so to you, Andrea, on maybe the nexus between IT spending and also distributions and capital distribution, so share dividends and buybacks. I've got to say, Sharon's comments have been pretty understanding and pretty positive, or at least in tone more so than I've heard from other ECB officials, also of late. But my interpretation, of course. But maybe you could speak to us about the delicate balance that a bank needs to strike in terms of saying, okay, this is the money I'm putting to my internal resilience, and this is the money I'm putting towards my external resilience, being attractive to shareholders, and getting that balance right, and how you come to the decision to divvy up the pot.
Firstly, I would say that it's all about balance. Okay, so if you look, okay, we're known for doing a lot of distributions, which by the way, we are the first bank who started large. We're the first bank who's paring back down. So we went up, we're down now. It costed us 20% stock reduction since we said that at the BAML conference, so on a relative basis. So we do that. I think a few things. First of all, we don't see it as a trade-off. Second of all, you have a number of priorities that you're considering when you're ending the year and you decide what you're going to distribute or not. In our case, every year in the last 3 years, we took between 1 billion and 1.5 billion of integration costs, which restated are becoming more efficient, write off old IT platform, invest in new one, create further buffers for provision for risk. And we have done that. We could have maximized our net income by not doing that. But we felt that that balance was necessary because the 3 years would end and then we would have another 3 years, et cetera, et cetera. And therefore we balanced that in a way. And this year, at the beginning of the year, we said we're not going to do any integration cost. It's a difficult year. We front-loaded, so leave us alone. In July, we saw that we were going to close the year well. We thought we were going to close the year making 9.3 billion. We will close the year at 10.5 or above. And in the third quarter, we said, we're going to do integration cost because next year is difficult. We're going to front load some technology. We're going to do. So I do think there is a balance all the time. I think when you look at technology, there are a few things to take into consideration. First of all, I think I don't want to talk too much about the sector, but I will anyway. Mm-hmm. I think most of the leadership, board and management does not know anything about technology and AI. That's the reality. We're learning, but tell me how many CEOs come from MIT. Yeah. And that is the point. And while if you ask me, what is the VAR and what is the market risk you want to take, it will take me about 10 seconds to give you an answer. If you tell me, I need to change my architecture from this to that, and it will lead to this, and that. Okay, let's sit down for a few hours before I get to the answer. Mm-hmm. If you look at my time, I probably spend 6 hours per week only on digital, but with the team understanding all the projects and where they are. So I do think you need to go over the line and say, no, I'm not delegating it. This is crucial and central, and I'm going to understand it. The second thing is, where do you spend it on? Very important, and Britta is absolutely right. So we feel, for example, I can have 2 banks spending 100. One has a very obsolete technology, and it's 100% on maintaining it. And the other one has a very modern technology, and it's 50% maintaining it, 50% iterating it and developing. Which one is the better one? But to the market, they're identical. Also because of what Britta said, try to find a CEO that will say in an annual report or in a presentation, we underinvest in technology and we underinvest in IT. Nobody will ever say that. So that is the question. What do you spend it on? The other question is, how good are you at spending? So the point is, there are 2 things on that. One, JP Morgan, in my opinion, is the big gorilla out there, said that in spending in technology, they probably, I think the number was that Jamie Dimon said, they probably pour 25 billion of spend down the toilet. A European bank cannot do that. I mean, the European banking system cannot do that. So that means you need to be a lot more cautious on how you spend, where you spend. It's risk. Because, and we are too used to more is better, more is not better. More is better if you're doing more in the right places, but if you're doing more in the wrong places, it is not better. So the quality of your spend and the minimization of there will never going to be zero of the risk that you go all in places and then you realize you need to write it off in full is very, very important. And the other thing linked to that is how efficient you are. So our unit cost for producing technology is down 30 or 40%. So you could see 100. With that 100, I'm producing 40% more than I was producing 3 years ago. So all of these things, if you're from the outside and you don't dig in the detail, very, very complicated. And then there is one last thing that I think is very important at the moment. So for us, the only way is up, by the way, in technology. But if you look at what management team are looking at now, it's not technology, it's AI. Technology, in theory, most banks have the core technology, which is resilience, ability to perform the service. So what we need to operate, right? The ATM not going down, the payment not going, so that functions. There was a lot of spend on other things around automation, et cetera, et cetera. That is being replaced by a lot more on AI because the time of impact is a lot faster. And I think that change is, again, taking management team to say, ooh, what exactly am I going to do in that? But it is very important. And that change totally transforms and the way the organization does. And I'll give you one example. Take the one that the ECB would probably very much welcome, the credit risk process. We always talk a lot about that. Credit risk process. Large files. To prepare a large file on a new client, probably 6 weeks. People taking information from the net, from the balance sheet, anything you have on the company, reclassifying on the standards of a bank. Then they prepare it, they run our own models, go a preliminary decision, and then there is a credit officer who will say yes or no. And if it's over, risk committee, okay? We have a pilot, like us, a lot of banks. With AI, we had a pilot that we prepared with an agent in 2 weeks. So time to market, 2 weeks. They did in competition, but something has started 6 weeks before with that person. They prepared the entire reclassified report with a recommendation in 12 minutes. Okay? And we went to look at, it was 99% accurate. Okay? So what does that mean then? That means that if I have a risk organization of 500 people, 400 don't have a job because they're all the people that are preparing the files. What do you do with those in a Europe that, for example, in Italy, I can only pre-pension? But also, how do you change the mind of people who need to disrupt their organization to such an extreme? Very complicated. And then there is the other question is, if you disrupt it like this, who will ever be the senior credit officer if you didn't come through the ranks knowing the credit files because you have a little ET telling you what to do? And so I think for us, you look at it on that, you look at on transaction monitoring, anti-money laundering, all the false positive, etc. Even advice to clients. If you asked a person to have an advice on what you would invest, is one thing. We have a pilot on an AI model. On your phone, you can put in, and they will relate to the last 15 times an event like that happened, and in those times, this happened, and then the pilot will tell you, do you want 3 strategies? And then they will come in seconds. Do you want me to execute one for you? It is, and how do you make sure that this is the right thing for the client? Now, so all of that, before you were like, I am going to be on the cloud 5 years, and I am going to migrate little by little. Now, on these things, you take a decision, you're operational 6 months later, and you need to think of all the ramifications of that and how the organization is going to judge that. So I think when we were talking about geopolitical risk, I would overlay geopolitical risk with a massive change that AI is taking in business model, in way of operating, in what is acceptable, morally and otherwise, on that. And these 2 things for a game of destiny are happening at the same time. And that is, I think that is the challenge on how you step back and say, how do I deal with that?
Okay. Two last questions to Britta and Sharon on AI before we move over to the Q&A section. So get ready if you have questions in a moment. So Britta, we had a lot of use cases now from Andrea. We had some also ideas of time, how things being sped up. But maybe you could set the scene for us a little bit in terms of sort of how much can be expected in terms of productivity, maybe also in savings from the adoption of AI within banks.
Yes. I think Andrea knows that I won't be able to answer all of those questions. But I think it raises an interesting point because when we look at banks talking about AI, we hear about a lot of these use cases, as you mentioned, but we haven't really heard about returns on investment.
Yeah.
We haven't heard about, these flashed out kind of numbers behind it. I think when we try to quantify it, I mean, one of the low-hanging fruit, for example, where we still see upside from AI in a relatively low-risk area is something like call centers. There's probably about 5% of bank staff that, could be at risk in these sort of areas. I brought another slide, if you want to see it. If you go to slide 6, on the right-hand side, we can see the use cases. This is again from our survey. We included more questions on AI and where AI is used in production. And as Andrea mentioned, a lot of that is in fraud detection, transaction monitoring, basically fighting AI fraud with AI, and customer service, some of the processes that were automated already previously. We find actually that in the slightly higher risk or more consequential areas of risk management decisions, for example, or also even compliance and regulatory reporting, we were surprised that there's actually, it's a little bit experimental, let's say, the deployment of AI. And I think these are all areas where you need to have accountability in the end, and it's very difficult to transfer that to a machine. So on the one hand, that makes me think that there are still opportunities, but on the other hand, I think it also shows that banks are quite cautious, treading quite cautiously in an area where there's a risk that we're moving ahead much faster than any sort of regulatory pace can keep track of it. The chart on the left just shows you another interesting data point, I think. We asked the banks what they expected spend on AI over the next 3 years would be. And as you can see, there's quite a large spread. Most of them were bunched around 1% to 3% of their cost base being in AI, which is, I would argue, probably not that much. But some of them intend to spend more than 10% or more than their cost base on artificial intelligence. So I think it's going to be a topic that will be with us for a long time. I think we sit here as kind of analysts, banks, regulators, but I think a lot of that will also be determined by kind of politics and other regulatory entities in terms of how we're going to, make sure that there will be an ethical deployment of AI in the future.
Mm-hmm. Okay.
I think a lot is competition will drive that. I think going back on that, I would say only one thing. The difference between, in my opinion, what I feel is technology and AI. Technology, you take a decision, you modernize, you execute, and you give your bank a lower cost to serve, a more efficient system, et cetera, et cetera. In AI, it's not a question of so much execution, it's a question of adoption. So the question is, going back to what I said about the credit process before, and supposing it works for a second, big assumption. Is the team ready, not to say I will save 10,000 hours, no. Mm-hmm. Change completely the model of operation in a way that they will be 500 people less, they will use AI, they will have check and balances, and then they will take the decision or not. So we have a lot of how much it makes you more efficient. Try to get an information on anything. You now can get it immediately, but are you changing the way you do things to convert that in efficiencies? And I think at the moment the answer is no. Everybody wants the tool. Nobody wants to change the model by which we operate to convert it in efficiency. I'm talking banks.
Mm-hmm. Mm-hmm. Indeed. Okay, and then just to Sharon, to give you the last word, I don't want to cast the supervisors as the party pooper again, as so often you do get cast. So, but maybe, I'm old enough to have reported about sort of the residential mortgage-backed securities. We know like PPI in the UK with payment protection insurance. There seems like, what do you expect of banks now in terms of building up the necessary governance to oversee their operations in AI in order to avoid getting into a position where they've accidentally or willfully misused customer data or missold things with this technology?
No, I think this is exactly the issue. So as has already been said, there's obviously the potential, I think, for widespread adoption. and for very significant impact on the whole operating model within the banks. Our own sort of internal survey here at the ECB shows that about 85% of banks are already using AI in some form or other. And there's a World Economic Forum study also that shows about 3/4 of banking sector tasks that are undertaken within the banking sector could be suited well to either automation or augmentation. So I think it goes to what Andrea was saying, is that you could imagine a situation, I think, where there's a pretty fundamental change in the whole business model and operating model. And many use cases, Britta showed the slide there in terms of what banks could do. So from our point of view, it's about trying to make sure, I think, that banks are sort of ahead of that. So we know there are big issues around bias, for example, in algorithms. The potential for benefits to cyber, yes, but also risks as well. Model explainability. I think Britta mentioned as well, one thing we'd be really concerned about, data quality, privacy issues, reputational risks for banks. So as always, I think it's, of course, there are opportunities, but it's about banks making sure that they can kind of keep up with these developments, that they really understand the risks that are there, and they have the right governance and risk management around that. I thought Britta's slide on, it goes back more to the IT part, on the number of board representatives and so on that have IT experience. And that is important, that there are people on boards that have IT experience. But I think what we see now is the nature of digitization, IT, cyber, AI, means that collectively, you know, the whole board, senior management really needs to be focused on this as a kind of big strategic issue across the whole bank and its business model. It's not just about IT investment anymore. So I think we have to really see that very broad perspective.
Okay, so I'm afraid the greedy journalist has eaten into your time for Q&A, but maybe we have 3.5 minutes. Maybe 2 quick-fire questions from the room. Is anyone who would like to break the ice, raise their hand, put a question to the panel? If not, the greedy journalist can keep going. We have a lady here. Could we bring a microphone to this lady here? And maybe there's one other person who wants to have also the gentleman at the back. Like I say, quick fire questions in order to have as long answers as possible.
Hello, my name's Kate Levick. I'm here from a think tank called E3G. I'm not sure if this is a quick fire question, but we've discussion on IT risks and AI has been fascinating. I'd just like to say there are other technological changes that banks are also exposed to. I'd be interested if the panel has any comments on the potential forward impacts of energy price volatility on mortgage books.
Okay.
And sorry
could also be one that comes up in the climate and environmental panel afterwards. But maybe and the gentleman at the back also had a question.
Yeah, perfect. Thanks. Sorry. Hi, Stephen Wolf, ECB. Quick question for Andrea. In terms of the risk management in general, you talked about AI. I suppose we've seen the last 20 years how, let's say, industrialization of retail lending has led to many younger bankers knowing the process, but not pure risk. If we embrace AI even further, what will bankers look like in 25 years' time?
That's a great question. I would ask you back the question. I have a 14-year-old. I used to memorize everything, and she's still very shocked when she's talking about something in math, and I say, so it's about that, and I'm more or less right. She says, how did you do that? Because she's used to ask ChatGPT or whatever for the answer, and the mind is not set up in that way. How do you change the whole educational system because we're going in that direction? I don't know, but we need to think about it because I don't think we can avoid it. This will hit us. So the question is a massive change to where we are. I think what it does is there are entire skills that are no longer relevant, roles that are no longer relevant. Now, do I necessarily need to prepare for 6 weeks, hundreds, thousands of files before I become credit officer and reclassify in order to have that judgment call? Maybe in a world of, I'm just saying maybe because I don't have the answer. Maybe in a world of AI, I don't. I need to be a person with a lot of judgment. I need to be a person that is included in the team that takes the decision, that goes to risk committee, but relies on data that is homogenized in a certain way. So maybe. What I can tell you is that we've done, with our culture, we've focused aggressively on empowerment because I truly believe that if you're sitting on 80,000 people, if you don't trust them, And if they don't operate in a framework that you can trust, you're toast, regardless of your controls, because you can't control enough. But one thing, for example, consumer finance. What is the difference between what we had before? You have a plafond of 500 million in this region to go and give consumer loans. Go. Or you're fully empowered, but you have an iPad with predictive models. You're punching what your clients has, which is an in-branch person, so one of our clients, and the models give you the answer as to how much you can lend to that client. And there is centrally a weekly report of how the dynamics are going. And if we don't like it, we become more stringent or less stringent. In a way, that is a lot tighter than the plafond before. And I see the results weekly, not 3 months later. So they are positive. And by the way, does the person on the commercial side who was giving a consumer loan lose the skill set? I would argue he never had it, or she never had it, because when you're giving a consumer loan to somebody who by definition needs it, so if you need 1,000 euros to do something, it's not like you're swimming in savings. You know, so I do think that that's a net positive. So how many net positives do we have, and how do we manage with a delegation of a lot of things to machines, and how certain are we that in not 98, 99.999% of the cases, this is going to work? And what kind of people do we need to train, and where do they go? We see the new graduates. The new graduates that are coming, we just hired 9,000 new graduates. It's insane, because when they come in, these people are AI enabled. I'm not AI enabled. They are. So they come in the branch, they come in the call center. Their mind works. I need that support, and this is going to push my performance in a certain way. We give them training the old school way, and we're still figuring out how the two things can mesh. So I think it's a good question, but I think I cannot underscore enough the level of transformation in how the role of a human in an organization as complicated as a bank is evolving, and the impact of AI and of all the things that are changing what we expect from them and the roles where we put them in. So I think it's something that we need to watch, and we need to be very careful, but it is what it is. The older generation is probably a bigger problem, because they need to adjust to this, and they never will. No? So we have a corporate university. We get, at the moment, we have about 2,000 people in retraining and upskilling, etc., to show them what my daughter does normally at 14 years old. So I think that transition for society, very important, because if you cannot recycle with this speed of adoption, you're going to have a massive problems. That's why we said lots of hours saved. Where are these people going? What are they doing? And what is the impact? With trade unions telling you, but you cannot let go of these people. And they're right. So I think it's all of that. I don't have an answer, but we are really stressing about this, because we see it faster and faster and faster, and we don't have the answer.
Okay, we're standing in the way of people's lunches, so maybe just to Britta and Sharon, is there any technology that jumps out at you that we haven't discussed today? Just to the lady point in the third row, I don't want to nail you down on energy data for mortgages, but is there something which we haven't discussed, which you think which jumps out at you as a technology that we should also be thinking about beyond the bingo card of AI and cyber?
Quantum computing on cyber.
Okay, well that's a good one. That's one for discussion over lunch. I'd love to learn about quantum computing. If there are any experts in the room, please tell me about it. But thank you to my panel. Thank you to the audience for a really fun and vibrant discussion.